Good evening, everyone. I'm Tanisha Bandari from NISM. NISM is the capacity building initiative of SEBI. We at NISM conduct wide range of activities at various levels with the objective of improving quality standards in securities markets. At NISM, we work in five broad areas: long and short term academic programs, certification for market intermediaries, e learning programs, training programs for working professionals, and various investor education initiatives. We introduced a series on future ready finances, investment planning for Indian investors, comprising 4 episodes. In Feb 2026, by Mr. Jitendra Solanki, today we present the fourth and last episode of this series titled Safeguard and Scale the Indian Investor's Long Term Playbook by Solanki sir. To introduce him, he is an RIA based in Ghaziabad, Uttar Pradesh, specializing in holistic financial planning and wealth management. With over 17 years of experience in financial services industry, he has been guiding individuals and families towards their financial well-being. He is also an experienced estate planner and provides comprehensive advice on succession planning, wills, trusts, and other aspects that integrate financial, tax, etc. His approach emphasizes structured, ethical, and client centric financial advice. Now, over to you, sir.
Thank you, Tanisha. Okay, right. So, welcome you all on this fourth and last episode of this series. And we have been speaking a lot about investing, how you should invest your money, uh, whether you should save money or invest your money, how investing impacts your long-term wealth creation. So today we are going to talk about how do you safeguard and scale your wealth, which means how do you protect your wealth and how do you multiply your wealth. So lot many concept you will find I have spoken about, but we are going to go through in a brief, and we will discuss more on how you mainly protect your wealth. So wealth is a process, not a product. So it's not something you can, invest tomorrow and suddenly wealth is created. It's a process you lay down for your long-term investment journey. And that's why there are no best investment. The no lot many time uh, we are searching that what is the best investment product for us, but there is never a best investment. It doesn't exist. Any investment which can fit into your life goals, meeting your financial goals, that is going to be the best investment for you. So there is no best investment process. When you create a process and you follow a discipline, plus you are there for a time, then you create wealth. So wealth is not created in a short span of time. Wealth is created in a long term, and that's what we have been speaking about, and that's what the wealth creation basic fundamentals are, that you follow a process, a very structured process. You follow a discipline and you are there for the long haul. That's when you create wealth in the long term. And right allocation gives you the highest return. No best investment give you a highest return. And if we look at the historic history, and if we look at investments today, then investment which is best today, you won't find that investment best tomorrow. Okay, so wealth creation is actually a process. It's a journey you have to take for yourself, and it's not a product which you can just buy and wealth creation happens. So there are no best investment. Best investment would be that investment which fits into your life goals. There is a process to follow, and if you can follow a process, you can lay down a discipline with it, and plus you are there for a long haul, then you create wealth in the longer term. And highest returns you achieve in your investment comes from the right allocation you have made. So this is the basic fundamentals of wealth creation. And wealth destructions happens quietly, much like we keep on searching for best investment, best returns. The wealth destruction is not something you even think of, but it is quietly happening with your money. How does it happen? So there are panic withdrawals, right? When we generally invest ad hoc, or when we generally invest, we make a wrong investment decisions. Then when markets go haywire, then there are panic withdrawal happen. Then trend chasing. So you chase a trend. You are not investing based on your financial goals, but you are chasing a trend. So something is in good trend, you are probably want to invest in that. Or we talk about tomorrow, so gold, silver rally we are seeing. So everybody now wants to be part of it. Everybody wants to invest into it. So when you chase a trend and you do not follow the basic principle, and avoiding equity completely. So these are the three main areas which I feel that wealth destruction happens. Now, in the normal course of life, we do this, but we do not look at the result it is going to give us in the long term. And if you are doing a panic withdrawal, you are chasing a trend, or you avoid equity completely. So you are a risk averse investor and you are avoiding equity completely. But we have seen in the last webinars why equity is so important. So these are those pressure points, I will call them, or those wealth destruction moments which you do not realize, you do not even think of, but you do it. So that's why I'm saying wealth destruction happens quietly. It doesn't make a noise. And overexposure to fixed deposits. So all of these whenever we are making any investment decisions, we have to look at that these are the areas, or these are the points, these are the things which are going to come up in the future, and you have to be really careful on that. So wealth destruction happens quietly whenever you make a panic withdrawal, chasing a trend, avoiding equity, or even overexposure to maybe a single asset class like fixed deposit. So risk versus volatility, and I think this questions comes up, many times, and everybody's look at that. What is the risk I have to take, plus what is the volatility? And generally, we use it interchangeably, right? When we say risk, it means differently, but when we look at volatility, it means differently. But risk is actually the volatility. What is volatility? Volatility is the market fluctuations. But what is risk? Risk is the permanent capital loss. And failure to meet goals is the real risk. So risk is not volatility. Risk is not market fluctuation. Yes, it can be a permanent capital loss, but the real risk is failure to meet your financial goals. And that's why it's important that we understand that how we are going to invest our money and how we are going to address these. But we should be very clear that volatility does not mean risk in your investment. Volatility is just a market fluctuations which is going to come into your investment when you are going to invest into growth asset. But the biggest risk for me is failure to meet your financial goals, which can come from whatever reasons are there. But when there is a failure to meet financial goal, and that's the real risk you are having with your investments. Sequence of return risk. Sometimes it's not only the returns, but the order of returns also impact an outcome in any long-term investment. Now, what do I mean by order of returns? Now, order of returns means that when you start your investing journey, so what is the returns you are getting initially on your investment? So sometimes you might just start, you might get positive returns in the initially, and then market fluctuates, and then you get negative returns. But when you start initially, then you might get negative returns for a few years, and then you start getting positive returns. So the order of returns can impact your outcome. Why it does happen is because whatever you returns you earn in the beginning, then that's going to become the base of your future journey. And what at the end of the uh, end of the day, end of the horizon, you are going to create a wealth will depend on what, where do you started. Early negative years hurt more. Yes, it does. If in the early time when you are when your investments are just on a negative terrain, then that does hurt more. Why? Simple, because that set the base for your next for your positive returns. And when the base is very low, especially the negative, then you have to achieve a higher return to meet the outcome, and it becomes very critical near your retirement. So whenever you are say somebody is starting a journey at retirement, though it will become very critical, because at what stage you are getting these returns will impact the outcome. So sequence of return risk will matter when you are investing in the long term journey, and that's why those mistakes of over investing plus mistakes of not choosing the right investment vehicle can lead to these kind of outcomes. So what is a margin of safety in personal finance? We know wealth creation is a long term journey. We have seen what does the risk hold, but what is the margin of safety in your personal finance? So whenever you are starting an investment journey, there are some areas which you have to think before that. Emergency funds, conservative allocation, insurance coverage, and avoiding over leverage. These are margin of safety in your personal finance. What do I mean by margin of safety? So whenever you are investing your money, it is going to come within your resources, and you do not have to just invest your money. You have to meet other financial aspect also. Let's say emergency fund, you have to meet emergencies also. And nobody of us wants that if we are investing for our financial goals, we should rely on that or withdraw from it if any emergency tomorrow arises. So emergency can be job loss, health emergencies, any eventualities happen. So you have to keep a margin of safety. So you need to have a good emergency fund. You need to have an allocation a bit conservatively, in a sense that you need it's not only completely growth asset. Some amount of assets should be there in conservative investments. Insurance coverage, right insurance coverage to meet those emergencies which can come, and avoiding over leverage in anything, made loans or any other thing. So these are the margin of safety for everybody that they have to follow when they are managing their personal finance. Liquidity is underrated. Why? Because assets without liquidity create stress. Let's think about real estate. We might feel that yes, uh, we have built up a good value with real estate, maybe holding five properties, but if they are not liquid, it will give you stress, because when you need the money, it won't be available to you. So assets without liquidity actually create stress. So you need to maintain accessible capital. You should have capital which is easily accessible to you. You can withdraw it, utilize it for whatever need it arises. Balance growth with flexibility. So growth doesn't come only with the one way. Your investment should be flexible enough. Your investing journey should be so much flexible that at certain time, if you have to change gears, you should be able to do it. So that's why I say liquidity is underrated. We do not consider so much about liquidity when we are investing. So when we are buying properties, we do not think of liquidity. Okay, when we are looking at growth, we do not look at flexibility. So it's important. Assets without liquidity will always create stress. So you need to maintain accessible capital, and your growth should be balanced with flexibility. Then comes the three silent wealth killers. So we have seen in the previous slide the destruction, how what are the points which create which destruct which gives you wealth destruction, which destroy your money, right? But these are also the silent wealth killers. Why I'm saying is silent wealth killers, because this is happening with your money but you are not realizing it. And this is not something you are taking action, but this is something which is there and you have to address it. So one is inflation, Rising prices, reducing purchasing power. So, what is available for 100 rupees today would be available for 150 tomorrow. So, your purchasing power reduced, taxes eroding investment returns, and then emotional decisions. So, fear, that panic selling, all these are emotional decisions which you take. So, these are the three silent wealth killers which everybody of us have to address when we are investing our money. So, my money should be able to beat inflation because I need to grow my money to ensure that what is available tomorrow at a higher prices, I am able to purchase it. Taxes, because higher taxes means lower earnings, lower income, so I need to address taxes. And then I have to address also the emotional decision. So these are three silent wealth killers which has to be addressed when you are going through your investing journey. Inflation impact, we know very well how inflation impact your money, and we have seen it before also. Like 6% inflation double the cost in 12 years. So 1 crore today become 3.2 crore in 20 years. So real return is not when you investing your money, real return is not that. Real return is inflation plus taxes. What you're going to get after that is the real return. So you do not have to look at only returns. You have to look at what is the real return you are going to get. So if there is a 6% inflation and you are getting a return of 8%, the real return you are getting is 2%. Plus there is taxes. So 6% inflation plus 20% taxes. So after that, what you are actually earning is the real return, or it's the real earning where your money is growing. So you have to focus on the real return and not the nominal return we say, you are going to get on your investment. Tax efficiencies of post-tax returns matters in real returns. Holding period matters. The longer you hold your money, the more you are going to grow it. And plus long-term holding, you have more tax efficiency, and asset allocation strategy is going to matter a lot. How you allocate your asset. So when you look at tax efficiency, then you select investments which are more tax efficient. So long-term journey, how does it happen? When you allocate your asset, you are looking at the tax efficiency also, which is where you are going to pay lower tax or where the tax benefits are in favor of giving you more income. So what is the core philosophy when you are making your investment? First, safeguard, then scale, and build a strong foundation that can create sustainable growth. So first, safeguard yourself. What do I mean by safeguard? Safeguard means those emergency fund, right insurances to buy. So first, safeguard yourself. Because if you are not safeguarding yourself, then you're going to eat out your investment. So actually, you won't create wealth in that case. So when you have safeguard yourself, then scale, then start your investment journey, and then scale up as you move ahead in your life. So you will build a very strong foundation, and your growth would be sustainable enough for your long life. So the core philosophy of investing should be that safeguard yourself first, then start scaling up and build that strong foundation. So now what is safeguarding wealth? So, we have spoken about safeguarding yourself in your personal finance. Okay, how do you safeguard your wealth? Risk management, capital preservation, and stability during uncertainty. So, when you are safeguarding, how do you safeguard your wealth? That you look at a proper risk management, you look at a capital preservation, and you build a stability during uncertainty. So when there will be uncertainty, your investments are stable enough to sail through that. So emergency fund framework, we are talking about risk management. So risk management doesn't talk about only on investment. Yes, investment, there is a risk management, but risk management means you are managing risk in your personal finance. Personal finance is the whole gamut. It's not only about investment, it's the whole gamut. So how do you do that? First is the emergency fund framework. How do you build it? Ensure that you maintain 6 to 12 month expenses, liquid and safe instrument. So whatever your emergency fund are, they need to be put into liquid and safe instrument. You do not need volatile investment. Why? Because these are for emergency. So when emergency comes, you can withdraw from this and utilize it. Prevent forced liquidation. So it should not give you forced liquidation. Means, let's say we're talking about real estate. So sometimes we tend to have good amount of properties, and one of the properties we will say, okay, fine, this is my emergency fund. When I need it, I can sell it. But suddenly an emergency comes in. You do not need the entire money, but it will force you to liquidate it, right? So prevents forced liquidation. So emergency fund, when you create it separately, so it will prevent you from forced liquidation and will keep your long term investment journey intact. Then insurance as protection. So first you have emergency fund, then you bring insurance as protection. So term plan for income protection, we know what is a term plan. So you buy a term plan so that your income is protected from the future eventualities which will arise. Health cover for asset protection. So you take a good health insurance coverage so that your assets remain protected. You do not have to forcefully liquidate them if any health emergency arises. And always avoid mixing insurance and investment. So don't look at that one single avenue can give meet both the requirement, insurance plus investment, fine, meet both your goals. It never happens. So avoid mixing insurance with investment. So take term plan for income protection, health cover for asset protection, and avoid mixing insurance and investment. So these are the two safeguard of your wealth. Why safeguard? Because if you avoid both of these, let's say, then you are going to forcefully liquidate your wealth creation. So you're going to depend on, or you're going to rely on what, where you are making your long-term investments. You're going to liquidate your long-term investment and meet any of these emergencies or any of those situations arises. So these are the two uh, aspect which protect your wealth. It is protecting your family also, but it is actually protecting your wealth also. Asset allocation is the real driver. I've spoken initially, there is no best investment. So there is nothing like that, that there is a best investment and it can give me everything. No, it's actually the asset allocation which is a real driver. Equity is meant for growth, debt is meant for stability, gold is meant for hedge, and cash is meant for liquidity. Now think of, can any one of these meet all your objectives? No, it doesn't happen. If equity is there for growth, it comes with lot of volatility. If you're going to give everything to equity, then the stability won't come. The panic selling, withdrawal, that will happen. So the debt in your portfolio can give you stability. Cash will always give you liquidity. So you have cash available, you can meet any of the goals. And gold is treated as a hedge against inflation. So the real driver of your investment is the asset allocation and not the asset specifically. Okay, this we have spoken. Rebalancing discipline. So we have done everything. We have safeguard our wealth. We have taken those protection, and now we are talking and we have made our asset allocation approach. But can investment be just one time exercise or one time task? No, it doesn't happen. So whenever it's an investment journey, it's a journey you are taking. There will be situations when things will change. Your investment portfolio might change, your asset allocation may change, the investment objective may change. Many aspects will come in. So how do you accommodate those aspects is with the rebalancing discipline. How do you make it? Annual review can be one of the aspect where you look at your investment specifically and see whether they are meeting your objective or anything in your investment has changed. and you can have the rebalancing done as per the requirement. But preferably annual review is one which helps you in creating that rebalancing discipline for those change which may arise for your investment portfolio. Restore original allocation. So as I said, when you choose an asset allocation, you might start with 60-40 or 50-50. Over the years, let's say it changed to 70-30. So will you continue with that? No. You might look at restoring that original allocation of 60-40. So you have to rebalance your portfolio. Automatically sell high, buy low. So that is the preferable rebalancing strategy, but there are other rebalancing strategies also. You might not sell, you might invest more. Okay, so rebalancing discipline helps you in accommodating the changes which will you will see with your investment over your investment journey, which might be 15, 20, 25 years. And we know how investment journey takes. We see a lot of changes. Your financial stages, you might see changes. Your risk appetite might change. So all of these changes will require rebalancing your portfolio to accommodate that. And this is how you create a rebalancing discipline. So if you can create a structured process, you follow a structured process, then you will be able to accommodate these changes easily. Equity represent ownership. So though I am repeating it, but without equity, I don't think we can really meet our financial goals, because equity is something which has to be there in your investment portfolio. It's an ownership in businesses, participation in economic growth, and it's a long-term wealth engine. So even for conservative investors uh, who have a low risk appetite, some amount of equity will always be required. And for simple reason, we have seen that silent killer, that inflation, taxes, those are the silent killer. And if I have to beat them, I have to generate good returns. And without equity, generating good returns becomes a challenge. Power of compounding. So non-linear growth, slow in early years and explosive in later years. Now power of compounding is something which comes in the longer term. It doesn't come in the short term. So there will always be a non-linear growth. You won't get the growth in say 5-10% every year. No, it doesn't happen. Sometimes higher, sometimes lower. So it's always a non-linear growth. And slow in early years, so you will see a slow growth. And power of compounding, really you see the growth when you have accumulated a good amount of money. So growth on 1,000 rupees, it's look very minimal, but if you look at the growth on 50 lakh of surplus, it will look substantial. So that's how it becomes very explosive in later years of life. So SIP example, I'm just giving you examples. How do you compound your money? 10,000 per month at 12%, 30 years can bring in 3.5 CR. So times multiplies money. The more longer you are keeping, the more money you are creating. And this is the journey of wealth creation. So it happens slowly. It doesn't happen instantly, but it multiplies your money once you have achieved a certain amount of milestone. And SIP, we have looked at the last webinar also, how SIP create wealth and why it can be one of the best investment strategy you have. Step up SIP strategies is increasing SIP 10% annually, maybe massively higher final corpus and matches income growth. So when our income increases by a certain percentage every year, how do we contribute more? We need to contribute more. A 10,000 per month in last slide, we have seen that grows up to 3.5 CR. If I can step up by 10%, the corpus may be more than double. Okay, so that's how the step up SIP strategy actually gives you a higher final corpus. But we also should remember that there are some behavioral gap. What are those? Investor returns generally are less than the fund returns. Why does it happen? This is because when we are through an investing journey, there is a behavior angle also. How our funds are doing, panicking at the time of funds not doing well, withdrawing the money, then, not having a good analysis, what my neighbor is getting, why somebody else got a higher return, why I'm not able to got a higher return, why I'm not able to participate in this short term rally. So these are behaviors which is there with every investor. And because of these behaviors, generally the research have, shown that investor returns are less than fund returns, because these behavior impact the investment journey. Buy high sell low behavior, we have seen lot many times that investors, especially, when you have limited amount of money to invest, they enter into this investing journey late, quite late. Okay, so the behavior changes to buy high, sell, low behavior. So, you buy high because the already the rally has happened. So now you are entering it. But if there is a loss in the short period, you will exit out. Okay, so these are behaviors which are there with each and every investor, but not everyone is able to cope up with that. And emotion reduces wealth. So whenever emotions come into your investment, it is going to reduce wealth, because you are going to take decision based on emotions, not from the angle of wealth creation. So what emotions can come in, any kind of biases might come in. As I said, what is your neighbor earning? So that is an emotion which can impact your wealth creation, because if that neighbor is earning more, you will always be in a stress. Why I am earning less? Okay, that will reduces your wealth. So there are behavioral biases which are generally comes when you are going through your investment journey. So there is a recency bias. So you will make decisions based on recent events, not from the historical past. So recent something, some asset class is recently is doing well. So you also want to participate in that journey. So you will look at that asset class. You won't look at what historically that asset class has given, and what historically which asset class has given what. So there is a recency bias. Then there is a herd mentality. So you will go with the crowd. If the crowd is following, today, if I have to take an example, gold and silver rally, look at the amount of surplus which is coming in. So that becomes herd mentality, because everybody is investing in. So I should also invest in. I should not be left out. The FOMO, fear of missing out. Then there is a loss aversion. You cannot see loss in your portfolio. The moment you see a loss, you will panic, or you will withdraw the money. And there is a panic selling. That panic, whenever you see your, investment going down, you will sell in panic. So all of these are behavioral biases which impact your long term investment journey. So you might be able to start an SIP, but if you these biases is impacting you, then you might not be able to continue your SIP for the investment journey. So that will impact your wealth creation. And market corrections are normal. Right, market correction is not something that it's a one time event, or something we do not see. These are very normal. Crashes are temporary. Market crash by so much, and panic selling happens. What is going to happen to my investment? But look at the historical past. These are temporary. The markets recover. There were market crash in 2008 also. There were market crash before that. But where market stand today? So market corrections are pretty normal. Recoveries are inevitable. So whenever market crash, then the recovery will happen, and they have happened, right? Whether small or bigger, they have happened. And discipline wins long term. Long term wealth creation happens only with discipline. If you're going to focus on market crashes, when it is recover, the uh, short term investment, what's going to happen in the short term, then you won't create wealth. Discipline wins long term. In the long term, only the discipline will give you wealth creation, because you will see a lot of these with your investment journey. In a 30-year investment journey, you might see, maybe 5 times these market crashes and recovering from that. But if you keep your discipline, stay invested, in the long term, you create your wealth. And standing today, probably somebody who has started his investing journey 25, 30 years back, he would have seen crashes. But today he's standing, strong. He has created wealth. So discipline wins long term. Time in market versus timing market. Missing best days reduces returns. Consistency beats prediction. So when you time the market, there are probabilities that you might miss the best days. Okay, simply because nobody knows what's going to happen with the market, right? And consistency beats prediction. So instead of predicting the market, if you are consistent in your investing journey, then you are going to create wealth in the long term. So it's the time in the market versus timing market. Look at that SIP example I have shown. 30 years, 10,000 per month, 3.5 crore, versus if somebody would have timed the market, would have come in, come out, come in, come out, come in, come out, the wealth creation doesn't happen. With that timing, you are actually just earning a return. You are not creating wealth. The compounding will never happen when you start timing the market, because timing the market, you won't time the market during entry also. You will time the market the exit also. And when you enter and exit, you miss out on compounding. So that's why the missing best days reduces returns. So you're going to miss the best days of wealth creation. So it's always time in market, not timing the market, which will create wealth. Returns without goals lack direction. So any returns without, so if your investment is not linked to any financial goal, then it lacks direction. So what happens with that? So you will focus more on returns, not on financial goals. And when you focus more on return, then those behavioral aspect come into picture. Why my neighbor is earning better? Why this asset class is not giving return? This asset class has not given return in the last 2 years. Why should I continue? So all those behavioral aspect will come into picture when you don't focus on goals. Your returns are not linked with your goals. And goal tracking improve discipline, because you have created a financial goal, you have matched your investment with financial goal, you know what returns I have to earn to meet that financial goal. So you will focus on the financial goal, you won't focus on the return, because you will know that that financial goal is the long term, so I have to stay invested in the long term. So goal tracking improve discipline and focus on funding objectives. So you should focus on what is your objective, not what is the return I'm going to get from this asset class. So the moment you focus on funding objectives, the investment journey completely changes. Then you are not looking at the short term, you are looking at the long term. The long term goal, you are looking at the long term. The short term goal, you are looking at the short term. So you will be clear. If you are clear with your objectives, you will be clear with your investment. And if you are clear with your investment, the investment journey is going to be much smooth. And wealth has three phases. So when you are creating a wealth, you actually have three phases. First is the accumulation phase. So you are saving and investing money to create that wealth over the long term. And that's where all the basic fundamentals of asset allocation, staying invested will come into picture. So there is an accumulation phase. Then there is a preservation phase. So what wealth you have created, now you want to preserve it. You cannot think of destroying that wealth, so you want to preserve it. And then there is a distribution phase. Now they have to utilize that wealth for your own expenses, or maybe transfer to your legal hires. So because your life stage has these phases, so your investment journey should be accordingly. So when you are accumulation phase, you should focus on accumulation. You're not looking at withdrawing the money, you are looking at more and more investing. And when you are looking at more investing, you are looking at accumulating money. So when you are accumulating money, you are not, do not think of withdrawal. When you think of preservation, maybe reaching your retirement, you have already accumulated wealth, now you want to protect it, preserve it. So you will look at changing the allocation. And then finally come the distribution of utilizing the money. So your wealth journey has these three phases, and everybody of us will have to go do through these three phases. And one should understand that how these three phases, how you have to manage your wealth. Capacity versus risk appetite. So capacity is financial ability within your expenses, within your savings, how much you are able to save money or invest money. Appetite is emotional comfort. So your capacity is your financial ability, how much you are able to save, and your appetite is how much comfort you have with respect to your investment when you see volatility in that. So somebody might be able to see 10% volatility, somebody might be comfortable with 20% volatility. So appetite means how much comfort you have emotionally seeing that up and down in your investment, and portfolio must align both. So your investment portfolio should be aligned with your capacity, means the financial ability you have plus the appetite you have. So you might have an appetite of 10%, you can't think of having a portfolio which you're seeing up and down of 20%. No, it doesn't matches your appetite. And capacity also, financial ability means, yes, everybody has to invest money, but you do not take leverage, and invest your money. You do not take loans and invest your money. That is not your financial ability. So your risk capacity versus risk appetite both have to be there when you are making an investment portfolio, and both should be aligned with your investment. The safeguard and scale framework. So there should be a risk profiling, how much risk you are comfortable with, the with the assets volatility in your investment, that should be identified. Then goal should be mapped with your investment, why you are making your investment, what do you have to achieve in the end with that. So that goal mapping should be there. Then the asset allocation should be drawn. Now what asset allocation will meet my objective? And then there is the execution. So this is the actual framework of investing your money. Having your risk profiling done means answering what is the comfortability, what is the comfort factor of yours seeing that volatility. Once you have identified that this is what my comfort factor is, then you map your goals with your investment. Once you have mapped your goals, once you have identified your financial goal, then you select the asset allocation strategy, what asset allocation you will follow, which will ensure that uh, it takes care of both of your risk appetite and your risk ability, and then you execute that. So you finally do your investment and start managing your asset allocation, and review and rebalance in the future. This is the actual investment. How do you safeguard and how do you scale? This is the framework. Without this, just think of, if you say, let's set aside, say you set aside risk profiling, you do not look at what comfortability, start investing your money 100% into something or 80% into something, right? uh, and then asset allocation, no proper asset allocation in that. At some point of time, it is because it is not matching your risk appetite, it is not matching your financial capability. At some point of time, this mismatch will probably destroy your wealth creation. Some point of time, you will see that uncomfortability coming with your investment. So there should be a proper framework when you are making your investment. Life stage investing, not exactly a thumb rule, but generally when you are early in your career, you are aggressive, so you can take an aggressive stand. When you reach a mid career, you can take generally a balanced stand because you have liabilities, responsibilities coming. Pre retirement, you generally move to protection phase, you want to protect your wealth. And when you are in retirement, you are income focused, you are focusing on drawing an income. So this is a life stage investing. So when you are investing at different life stages, this is how the investment focus would be. But as I said, not exactly a thumb rule. Even in your retirement years, you can take a balanced approach when your income is sufficient to meet your expenses and you have still surplus available. So depends on. But yes, largely this is the life stage investing generally happens. Then there should be portfolio stress testing. Okay, we are generally, we are hearing a lot of this on portfolio stress, but any individual investment portfolio should also this is stress testing. What if the market falls 25%? Now, what if income stops? Are goals secure? These are the answers uh, which will answer your whether you have selected the right portfolio or not. What if the market fall 25%? Are you comfortable? So if you are comfortable, fine, your portfolio might be okay. But if you are not, then you have to relook at your portfolio. What if income stops? If your income stop, then how your portfolio is going to, are you going to withdraw from the portfolio? Are goals secure? Are goals secure with this portfolio? So this is a portfolio stress testing. Basically, whenever in your investment journey, whenever you have to look at your investment portfolio and you want to test your investment portfolio, two or three questions like this can actually give that will there be a stress on your portfolio or not. So it's not a stress on you, it will be whether your portfolio be under stress or not. You might not have to withdraw from portfolio. Okay, so there it should be there, it should be there with your investing journey. These portfolio stress testing should keep on happening. Okay, so that was wealth creation in the longer term. How do you safeguard your wealth and how do you protect your wealth and how do you make long-term investment as a journey and not an ad hoc decisions. The next come estate planning. So I'll just touch upon brief on estate planning. It's a structured transfer of asset. So today we are there, but tomorrow after us, the assets or the wealth we have created has to transfer to the next generation. So what are the ways and means of it? So it's a structured transfer of asset, ensuring assets go to intended beneficiaries. So you have in mind, whenever you have wealth is created, you have in mind that okay, this wealth should go, should be divided between wife and children and whatever designated beneficiaries we have. So estate planning ensure that asset actually go to the intended beneficiaries, reducing disputes and delays. So there should not be family dispute because of your wealth you have created, and shouldn't be delays in transferring those assets to the intended beneficiaries. So when you address these, then actually when you are planning all these, it's called the estate planning. So what estate planning matters? Avoiding family conflict, prevent legal complication, protect minor or dependent beneficiary, ensure tax efficient transition. So generally, when you have plan well for your wealth creation transfer to the next generation, then one, it's avoid family conflict. You are taking that into consideration. Prevent legal complication. So estate planning prevent a lot of legal complication which may arise transferring wealth to the next generation. It protect minor or dependent beneficiary. So there might be beneficiaries like minor children or other dependents, like special children who might be dependent. So when you do an estate planning, you protect their interest and ensure tax efficient transition. So transition which is happening also is tax efficient when you go through the estate planning. So key estate planning tools is will, trust, if required, updating nominations, power of attorney. So these are the key estate planning tools in India. I'll can add one more, that's a living will, not actually with estate, but protecting your estate. So these are the key estate planning tools in India. Importance of writing a will. So clearly defined distribution, reduces ambiguity, protect family interest. So when you write a will, you are clearly defined how my asset should go to the next generation, how my asset should be distributed among my legal heirs. You have clearly defined it. Okay, because the law does not define this clearly. The law has a specific standing and it is distributed as per it. And then there is a lot of paperwork, might be legal complications. So when you write a will, you are making things smoother. So you're clearly defining distribution, reducing ambiguity. So any ambiguity related to the wealth you have created gets reduced when you write down a will and answers and write it down clearly that this is how my wealth should be distributed. Protects family interest. So your family has the first interest in your wealth. So it protects family interest, who's going to get what, and should be reviewed periodically. So once you have written a will, it should be reviewed periodically so that whatever changes happening in your wealth and should be accommodated. Now, question is, when should a will be written? My take is whenever you have created a single asset, the will should be written, because how that asset is going to go to your legal hire after you should be clearly written down in the will. Role of trust in wealth preservation, the useful in complex family situation. So family trust in India we have, and lot many families are forming a trust. Generally you might have complex family situations, you want to protect the wealth, does not want wealth to go directly to any of beneficiaries, then trust comes helpful in those provision. Protect minor special need beneficiaries, so a trust can protect a minor or special need beneficiary in the long term. Structured distribution over time. So you do not want to distribute now, you want a structured distribution over the period of years. That can happen through trust and can offer asset protection. So it does offer asset protection, that once you create a trust, transfer the asset to the trust, then those assets are protected in the trust because they will be utilized only for the beneficiary benefit. Nomination versus ownership. Nominee is a custodian, not a final owner. And time and again, lot many court cases have also, illustrated this fact that nominee is a custodian. So whenever you appoint a nominee in your bank accounts or in your mutual funds, so he is a custodian, not the final owner. The final owner who would be your legal hires as per the provision of will or as per the law. So the money still have to be divided between the final owners. Will determines ultimate distribution. So either the will or the succession law as such, they determine the ultimate distribution. So you might have a one single nominee appointed plus, but you might have three legal hires. So the money has to go to three legal hires. Institution might transfer the money to the nominee, but then the nominee has to transfer their share of the other legal hires. All documents must align. So whenever you create a will, or any other document, your nomination should align with that so that the layer of transfer can be reduced. So if any bank account you want that go to your any child, that child should be made the nominee in that bank account. If you made somebody else as a nominee, your money will have to be transferred from there to this child. So the layer of transfer get reduced. So all document must align with each other. So will has to align with the nominations. So an integrated wealth framework, what is an integrated wealth framework? Safeguard, protect current wealth, scale, grow wealth systematically, preserve, transfer wealth efficiently. So this is the wealth framework I've spoken about today. That safeguard, protect the current wealth with the provisions we have spoken about, insurance protection, have those insurance be there with you. Scale, grow wealth systematically. Scale, grow your wealth systematically. Don't think that wealth can be created in a short span of time. Preserve, transfer wealth efficiently. So preserve your wealth and have the right documentation done, or have the right tool, use the right tools so that you can preserve your wealth, which is intended for the beneficiaries, or you have created a wealth for yourself plus to pass on to your uh, dependents or legal hires. So protect first, allocate strategically, stay disciplined, and let compounding work. Right? I think that's so I'm over with my presentation, and maybe before we take question answer, Sahil, I think we can run up the poll.
Yes, so I will run all the polls together so that they can answer all the questions. Yes, done.
Okay, so I have given all questions in one poll only so that we can save time. So what is the biggest real risk in investing? Is it market volatility, temporary price decline, permanent loss capital or failure to meet goals, and low short-term returns? According to the safeguard principle, what should be built first? High return portfolio, equity exposure, emergency fund, protection structure, real estate investment. Why is asset allocation important? It increases short returns, reduces tax liability, balances growth and stability, and eliminate risk completely. In long-term investing, where is the majority of wealth created? First 5 year, first 10 years, middle phase, or last years due to compounding. And What is the main purpose of estate planning? Is avoid investing in equity, maximize short-term gains, or ensure smooth transfer of assets to intended beneficiaries or avoid all taxes. And lastly, who is the legal owner of asset after death if a nominee is mentioned? Is it nominee? Is it legal hire as per will, bank, or executor? I think we have spoken on all these five aspects, and I think all attendees should participate in this, and we should get a good score on these polls.
Until that time, attendees can ask their question in Q&A
Yeah.
so that sir can address those questions.
Okay, so I'll read it. If during gold time, suppose after 10 years when anyone need money, that time market crash occur, what will be the strategy for this situation? Okay. So it doesn't work like this. If your goal is 10 years ahead, you do not keep your investment till the last moment. Before 2 3 years before your goal, you actually start preserving your accumulated money, right? So say suppose the goal is after 10 years, and so before that, before 2 years before, you will start switching your money to a much more I would say, less volatile, secure, asset. So the strategy, there is always a strategy of preserving your wealth. So you do not right from the last day of when your goal is arrived, you do not keep the same asset allocation till that time. The asset allocation changes 2 2 years or 3 years before the goal happens, and that's where you preserve whatever wealth you have accumulated. You start preserving that. When we should have to sell, what was the right time to sell? So there is no right time to sell actually. Okay, there are two things. One, when your goal is nearing, right? What that is one, that is a right time. And second is when you have achieved your objective. So there is no right time to sell, right? That I have to sell now, or no, I have achieved my, I haven't still achieved my objective, because selling should not be based on how market is acting, but selling should be based on completely on the objective. So when you're nearing your objective and you have to preserve your growth, would be selling and maybe entering into a more fixed avenues, right? So that would be the right time to sell. And basic principle is buy low and sell high. So that is the basic principle, but doesn't mean short term buying and selling, but it has to be aligned with your investment objective or when the goal has to be achieved. Is tactic asset allocation good to create wealth? Not really. Tactical asset allocation, not completely, I would say. As far as your financial goals are concerned, so there should be two portfolios. One is a core portfolio, which is completely based on the asset allocation strategy. That asset allocation strategy or core portfolio is meant for achieving your financial goals with a certain return you have assumed. The tactical asset allocation is mainly for enhancing the returns. Okay, so your goal or a wealth creation journey would largely depend on the core asset allocation. The tactical asset allocation, you might change it very frequently also. You might change it frequently also. You might not stay invested till the goals. So that is be more for enhancing the returns. But your goal allocation or the main strategy for achieving your financial goal should be the core asset allocation strategy. Okay. As I'm 19 now, if I wanted to build my career in this investment and trading side, what should I do take after my BTech and build a successful career in this SEBI? So, if you have to build a career in investment advisory, so there are two, three options. So, if you want to build career in investment advisory and wealth management, then you have to take a SEBI license today. Okay, so you have to register as an RIA. If you want to make a career in research, then but this is about when you want to make a career yourself, you want to start yourself. But the careers are, you can be an investment advisor, you can be a wealth manager, you can be in research also. So there are different careers depending on where your interest lies. You want to make into research side, there would be a separate, education for that. But as you return, you want to investment and trading side. So trading में career banana, it's really, difficult. But I think probably two, three options you have, you can look at it. So I am a registered investment advisor. I own my own practice. So that is my career. So if you want to start your own practice as an investment advisor, then you have to become an RIA. A trading side, depending on, if you want to become a trader, you will have a different education and different acumen. So that is going to be a different career. But specific educations are not required when you want to become a trader. Okay, a basic education plus understanding of trading activities there. But I won't be able to answer on that career side. Probably somebody else may be, able to answer on that. So there are questions is, do we need to add gold in our portfolio? Investment goals is for 25, 30 years. So need to add gold or not, I look at gold as more an asset allocation diversification. So gold is good as a diversification asset. So if you have gold in your investment portfolio, probably you will have a good diversification with your investment. So I think gold is good as a diversification when you are investing for 25 or 30 years. I'm preparing an ISM 10A exam. Please guide me for learning. So an ISM 10A exam, they give you a book when you register for it. So you can go through that book. Plus there are, I think specific courses also which are run, which you can, join and learn, and any specific. And there are lot many other books also apart from that which you can read and which you can, take guidance, or probably, you can join any RIA and taken guidance on an SM 10A exam. I am research analyst through an institution. I want to land into core research. So what can be best way to get into that, which course or certification of NISM RA? So one is, there is a basic education criteria for becoming a research analyst. But if you are a research analyst through an institution, then there are educational, higher certifications which you can think of. I'm not sure. Sahil maybe answer. If any exam is there for research analyst by NISM. Is any age limit for SEBI RIA? No, there is no age limit. Maximum age limit there is no. Minimum age limit, yes, it is there, but no maximum age limits. Okay. Sahil, can we have the poll results now?
Sure, sir, sure. I'm sharing the results. Yes, I have shared the results.
No, I don't see the result. I am seeing the questions only.
Okay, okay, no worries. So, for the first question,
Yeah.
59% of the attendees have selected the correct option, that is the permanent
Okay.
loss of capital or failure to
Hmm.
meet goals. For the
Hmm.
second poll, 84 of the attendees have selected the correct option, that is emergency fund and protection structure. For the
Hmm.
third poll, 89% again has selected the correct option, that is it balances growth and stability.
Good.
And for fourth one, 73% of the attendees has selected correct option, that is later years due to compounding. And for fifth poll, again 80% of the attendees has selected correct option, that is ensure smooth transfer of asset and indeed beneficiaries. And for the last, 65% of the attendees has selected correct option, that is the B1 legal hire as per will.
Well, good contribution, and I think a lot of understanding has been there in today's webinar, that what I have spoken about, and most of the attendees have understood that. Okay, so there are some questions I'll answer that, very brief. So if your child is a nominee in bank account, later you have made trust, can that wealth transfer to trust where child is beneficiary post demise of parents? No, not really, because bank won't transfer it to the trust. Bank will transfer it to the nominee. So you will have to write a will, and in the will you will have to state that this money
Thank you,
should
sir.
go to the
Thank you so
trust.
much. Thank you. It was great.
Okay. Uh,
Thank you. It was great.
Is
It was
CFP can
great.
register as RIA? Yes, you can very well register as an RIA. Is there any limit for RIA? No. As a student, what's the strategy used for clearing a NISM exam? So register for NISM exam, get in contact with Sahil, and you can know. But yes, as far as strategy for clearing an exam, I think the study, you get a course material, study that. Plus, apart from course material, also study and keep, attending these regular webinars which are happening. I think you will learn a lot and which will be good for clearing your NISM exams. Okay, I think those are the questions. An MFD register for RIA? Yes. Yeah, I think Sahil, I've answered all the questions now.
Okay, so are we good to end the session?
Yeah, I think we can end it now.
Okay, let me check. The people means the attendees who are asking regarding the exams and all, they can visit NISM website for more information where they will be able to find all the links and all. Yes, so I think, sir, you have answered almost all of the questions which were asked. Let me check. Yes. So, sir, are we good to end the session?
Yes, I think we can end the session. We are over time also.
Yes, we are. So, thank you, sir.